Ashish Gupta, CIO of Axis Mutual Fund joins us. Now let's take our conversation forward. Ashish, in the overall scheme of things, the way you invest and the way you manage money, what would be the importance of the election event? Because historically, this event tends to have a swing on the market, 5 to 10%, depending on the verdict and depending on the positioning.
It is event very keenly watched by the market, certainly. But I think more than political outcomes, but we have to focus on what are going to be the likely economic outcomes for us. If we see one of the mainstays for the India story last few years has been the macro stability that we have attained. If you look at the risk premium in India, it is much lower than what it used to be, and for good reason. Inflation has consistently been lower than historic trends. We have much more stable currency. We have a current account which is either in a minor deficit or a minor surplus. And even if you look at the bond market, the bond yield premium that India has is much lower than what it has historically been to say global developed market bonds or US bonds. So I think what we need to focus on is uh, post-election based on the outcomes, what is the outlook for macro stability? And I think what we are looking at is not just the election outcome, but also what happens in a few weeks after that when the budget of the new government comes in. And for us, staying the course on macro stability is really the key. Because I think otherwise, for the corporate sector, the earning trajectory is fairly consistent. There are various cyclical factors that are supporting the economy, and we want the political establishment to continue to support the macro stability.
Okay. Uh, Ashish, but is it fair to say that irrespective of the election verdict, looking at the current construct of the market, Indian markets, the breadth is deeper. We are no longer hostage to FI flows. DI flows are strong. Irrespective of the election verdict, the market reaction may not be very harsh for an extended period of time.
So I think for an extended period of time, I don't think these events matter, except for, as I said, what they translate into economic realities, right? And I think that is what we need to watch out for. Uh, Clearly, in the short term, market has certain expectations that are always priced in. If around those expectations, the events don't come out as the market anticipated, then we do get short-term bouts of volatility. What you spoke of, that market swings 5-10% around elections or post-elections. I think one good thing is that some of the expectations have tempered down over the past couple of weeks. So I think the market expectations about a month ago was really very one-sided. I think some of those expectations have tempered down, and I think that is a good thing in terms of the potential, the risk factor just going into the event.
Track banks very, very closely. There is enough reasons for banks to outperform. Credit growth is strong, NIMs are strong, interest rates are stable, retail is growing, NPAs are not there. Yet banks, they are underperforming. Is there a technical factor here, or it's a matter of time the outperformance will start?
I think there is clearly a technical factor which is around the ownership. There is also fundamental factor in terms of market is always forward looking, and really it focuses on what is the potential going forward. And I think most people will agree that probably the best profitability of banks has been observed in the past 12 to 18 months. and there is likely to be moderation in the profitability in the next 18 months, particularly if interest rate cuts start to come through. And having said that, I still think banks are a good investment potential, given that even though profitability will moderate, it will still be very, very healthy. Most banks will still deliver more than 15% ROE, right? The other factor we have to kind of think about banks is the fact that over the past decade, only pockets of, within the banking system were performing well, both in terms of profitability and growth. And therefore, what you were seeing that there was large disparity in valuation between one set of banks versus most of the other banks. And I think as the performance has equalized, if you look at most public sector banks, they're also now delivering more than 1% return on assets, return on equity. For some of the largest public sector banks is even higher than private banks. So you have had both growth and profitability equalizing across the spectrum, and there has been a similar impact on valuation. So the valuation range for the banking sector has narrowed. So I think we need to look at the banking sector holistically, and in that context, I think it is still quite well positioned.
Ashish, assuming it's a continuity of the current regime, which we'll come to know very soon on June 4th, do you think the portfolio strategies should be more of the same, your capex, financials, etc., or would you be making any or recommending any tactical changes?
I think we have had fairly consistent policies over the past 4 or 5 years. So I think portfolio positioning reflects that. The portfolio positioning also reflects the fact that we have some very favorable cycles playing out on the investment side, industrial, power, real estate. And really, we want to capture the earnings growth potential in these segments because many of these cycles are still in their early stage, and we see fairly a good tailwinds to this cycle over the next 2 or 3 years. So I think it's unlikely our portfolio positioning will change very much. In fact, many of our calls actually transcend the election cycle. So, for example, it's irrespective of the election outcome, I think it's fairly certain that we will be facing some sort of power deficit in the coming months. We, we are fairly certain that indigenization will continue to drive order books and revenues for defense companies. So I think some of these are really not very leveraged to the election cycle, but I think overall market multiples, etc., do get impacted because of how the macro might shape up based on the election outcomes.
So, I mean, why are metals rallying the way they are? It's a global phenomenon. But if metals are rallying, then is it a matter of time inflation will come back?
So I think we have to be slightly circumspect of the rally in commodities. Clearly, over the past few weeks, in fact, last 3 months, there has been some more optimism towards China. If you see over the past 3 months, it's one of the best performing markets. There have been measures announced by the Chinese government to stabilize the real estate market. But I still think really demand coming back in that segment on a global basis is still difficult. If you see China, real estate is plagued by overcapacity. Inventory levels, real estate inventory levels are nearly 10 times sales. So it's very unlikely that even as maybe the bottom for Chinese economy or markets may be getting formed and sentiment around that is improving, we are going to start seeing positive delta in demand for China for many of these commodities. And as you would know, Chinese construction sector and in particular real estate sector had been the biggest driver of demand for some of these commodities. So I think we have to be cognizant of that. There is, of course, the other concern about how the dollar has been weakening, and that's been really propelling some of the metals, particularly the precious metals. I think that is a trade that probably has more legs compared to the industrial commodities.
Great to have you on the show. Thank you so much for taking the time out and joining in today.
Okay, thank you.
Okay, that's the view coming in from the House of Axis Mutual Fund.
If you like this video, then like, share and subscribe to ET Now.